Good afternoon. My name is Oren Hahn with Early Growth Financial Services, and we're here with two of our CFOs, Alaa Ismail and Sirk. We're going to be talking about startup accounting essentials, what every startup needs to know in order to get the basics covered. And with that, Sirk, I'm going to turn that over to you.
Good afternoon, everyone. Thank you very much for joining us today. Just a little bit before we get started, just a little bit about our firm, Early Growth Financial Services. We are a full-service accounting and financial services firm that assists small and medium-sized companies with their accounting and financial needs. And we do it on a kind of go-as-you-go, grow-as-you-grow basis. So really for early-stage companies here in the Bay Area and in many of our markets, that typically means tech startups, but we also work with other smaller companies who don't necessarily need to or want to hire people full-time for their accounting and financial needs. We basically provide four main types of services. On an annual or per instance basis, we do corporate tax returns. We also do valuations, so company valuations for companies who are, for example, giving stock options. You're supposed to be doing a company valuation to price the strike price of your common stock for your stock options, and so we provide that on a per needed basis. And then our bulk of the work that we do is working on a consulting basis for companies where we do both the day-to-day, week-to-week, and month-to-month accounting and bookkeeping. And in addition to that, we also offer kind of higher level, call it controller / director of finance / CFO level services. And we help companies make strategic, sound decisions to assist them to grow. So we kind of provide kind of the full gamut of services that a smaller company might want or need so that they can focus on their prime objectives, which is, in most cases to develop product and to start getting revenue.
Well, thank you for that. And with that, we'll begin with talking about pre-funding. What are some of the things that companies should know before they've received any funding?
Okay, so hello everybody. This is Alaa Ismail from Early Growth. I'll just kind of start by pre-funding. I don't necessarily mean that the company has no money in the bank or is inactive. Pre-funding is really before any company raises any kind of serious capital that outside investors or angel investors, venture capital, or even convertible debt. Just prior to you getting any kind of serious equity financing or debt financing into the company is what we'll be talking about in this next section. The number one thing that all entrepreneurs or folks who are just starting a company should start doing is really kind of getting things organized. And one of the ways you do that is you start separating your personal expenses from your business expenses. And some of the ways that you could easily do that is that open up a bank account. If you've been incorporated already, the paperwork that you have for the incorporation is all you need to go to the bank of your choice and open up a corporate bank account. So you could start segregating the business-related expenses from your personal expenses. If possible, get either a debit card or a credit card that is also separate from your personal items to help facilitate, to further facilitate the segregation of expenses. And then finally, just make sure that as you're going, that you create an audit trail. It's very easy, especially in the early stages when maybe the company is not top of mind, but to just kind of acquire things, goods and services for your company and not really think about the related documentation. But just make sure that as you grow that you're getting this paperwork in order. The other thing is separating the reason why you want to separate your personal and business expenses from the very beginning is that you definitely want to get a good idea of how things are going and for the company. By separating the financial impact, not only do you kind of clear the way that for you and your potential investors, but it gives you an idea of where things are at any given time by just looking at your bank account. You don't even have to have a formal accounting system, but you look at your bank account, you get an idea of the money going out the door on a monthly basis. When early on, also, you might not have formal processes for collecting money from potential customers or for sale of goods and services. Make sure you collect all the payments that are owed to you. The next thing that I think is really critical is that if you have payroll, select a payroll company. Do not do payroll on your own. The penalties for late filing of payroll taxes and incorrect filing of payroll taxes are pretty steep. The liability of not transferring collected tax to the government entities is pretty large for the officers of the company. So make sure that you picked a payroll company to the extent that you are paying payroll. Keep all, as I previously mentioned, make sure that you keep all your receipts and invoices. There are several services out there, such as Bill.com, that could be your accounts payable repository. Very easy to use. Anybody could get it. It doesn't matter if you have 1 or 2 transactions a month. It's a pretty slick thing, very inexpensive. And it acts like your accounts payable repository in the cloud. Just remember that the IRS requires documentation for any expenses over $75.
Oh, thanks very much for that. And Sirk, would you like to talk a little bit about cap table management going into some of the other areas that we handle?
Sure, I'm happy to do it. Yeah, so cap table, if you are a company that is going to be, obviously at some point, if you're going to be raising money, you're going to be doing it in equity. Even before that, there may be splits of the equity between yourself and other founders. You may be giving stock options to employees. Basically, keeping track of who owns what percentage of the company, how much stock, and the different classes of stock that different constituents may own is really, really critical. If you are a sole proprietorship or a partnership of some kind that is not really doing it in equity, then that's not a big issue. But for many of our clients who are tech companies who are ultimately going to raise money from outside investors, then keeping track of your equity and your cap table is really, really critical. So doing it early at this stage, at a pre-funding stage, is going to be pretty straightforward. But as you kind of move forward and as you have different classes of stock and more shareholders, then making sure that you're keeping a good track of it, either doing it on your own or using a cap table management system is going to be very, very critical.
Thanks very much for that. And that brings us into a compliance obligation that can come up. If either of you can tell us some about that.
Okay, I'll take that on, Sirk. So the one thing that you should also be aware of, regardless of the activity that you have during the pre-funding stages, are your tax obligations. Remember that even if you've been incorporated, you are required to file state and federal tax returns. For example, if you file in Delaware, Delaware has an annual filing requirement regardless of the activity. So you have to be cognizant of the Delaware annual filing. If you're whichever state that you have, they have various annual filing requirements for taxes, and also things like Secretary of State certificates and other annual filing requirements. So just make sure you keep abreast of the different deadlines, and that you retain somebody, or if you're predisposed to do your own taxes, that's fine, but just do not get far behind on that. Again, the penalties are steep, and very early on, the related cost of doing these things is nominal compared to the fees and penalties that you could be charged. Also, be aware that if you need to do any kind of business licensing, it's not just the state, but for example, in San Francisco here where we are, there's very rigorous or business license filing requirements, and there's also city taxes that you have to be aware of. So in the pre-funding stage, just make sure that you're aware of all the different compliance, tax, and state obligations.
You know,
Thank you very
if
much.
I could just add, just kind of two takeaways from this initial section. I think that everyone should just make sure that you follow is this, right? Is that number one is that you need to make sure that wherever you're doing business, state, local, as well as obviously federal, that you understand, when the tax, what is required from a filings perspective, and when it's required, right? So you can, find calendars online for whatever state you're in, whatever jurisdiction you're in. Delaware has their own if you're a C Corp in Delaware, and just make sure that you know what those dates are and that you are filing correctly. Obviously, we encourage you to use someone like us or another financial services provider who can help you with your federal taxes. Corporate taxes are a little bit different than individual, and so we encourage that. But if you're going to do it on your own, make sure you do understand it. The other thing I also wanted to just add just a tiny little bit to Ala's comments about segregation of the business and personal transactions by setting up your own a separate bank account for your business, as well as credit cards, debit cards, everything that's related to it. From a tracking standpoint, obviously it's important that we know how much we're spending on our business as opposed to being commingled with personal stuff, but also from a liability standpoint. And this is really something that, if you are commingling your transactions, like let's say you are paying for business expenses from your personal checking account. Well, a case can be made that basically you are kind of one and the same, that your personal business is your business's businesses. And one of the reasons why we set up a C corporation or any kind of a corporation is to segregate the liability of that business from our own personal liability, right? And so by not segregating the expenses or the transactions, then someone could make a case down the line that, let's say they want to sue the company. Well, if we don't have a firm delineation between the two, then they could potentially make the case that, hey, listen, it's clear that this individual was running both the business and personal from their personal bank account, and therefore I can go after the personal assets as well as the corporate assets in terms of any kind of a lawsuit.
Right. Yeah, Sirk, those are excellent points, and a couple of other things to add in the pre-funding stage as far as mindset. It has never been easier to kind of run things on your own and to be organized and make sure that you're in compliance in a corporate environment than it is now. There are so many tools available. Of course, we would prefer, that you hire a qualified professional to help guide you through these things. But to the extent that that is not practical or the activity is not there are just several resources out there that will help you. From, as I mentioned, Bill.com for your payment platform. Payroll services are so easy to get on, something like a Gusto or Intuit Online. Intuit Payroll Online. They're very, very easy to use and will help get you to the the organization and compliance and all the different requirements early on without really a lot of hassle. You know, this current environment is just made running a business in the early stages a lot simpler than it used to be.
It's also not very expensive, you know, some of these tools like Alaa mentioned, you know, for a couple of people, you know, signing up for Intuit Payroll or Gusto is not very expensive. And, you know, as Alaa mentioned before, the penalties for doing something wrong in this area are so great that it's just not worth taking the risk of doing it yourself when, you know, you could have a professional who does this for tens of thousands of people and hundreds or thousands of companies do it for us.
Well, thank you both. And we've talked a bit about the pain of not getting it right, but onto a more pleasant topic. All of this paves the way for fundraising, which I know is of interest to many of our clients. And we can go into that topic next.
Sure, absolutely, and I'd be happy to do. And we recognize that this isn't necessarily startup accounting, but you know, at this stage, a lot of our clients are, even as they're kind of starting up their business and figuring out how to set up some of the infrastructure, they are obviously looking forward to fundraising. And so we just kind of added a couple slides in here just to touch upon it. We offer, we meaning Early Growth Financial Services, we offer lots of presentations, different areas of fundraising as part of our webinar series, and so we encourage you to, you know, keep a lookout for future upcoming webinars in this space, as well as even being able to go back in history and listen to or watch some presentations that we've done in this area. But basically, there's three things that you're going to want to prepare. And Oren, if we could kind of go back to the slide before.
Sorry about that.
So there's three basic things that we're going to want to prepare as we get ready to fundraise. And that's, you know, an executive summary, a pitch deck, and an elevator pitch. And for those of you who are not familiar with these things, the executive summary is just basically a 1 to 2 page document that can be forwarded. That kind of explains at a high level kind of what we're trying to do, what stage we're at, what markets we're trying to go after, and any other salient points that will help someone who sees it for the first time understand kind of what we're doing, what the opportunities are, the potential for our company is, so that they may be interested in potentially listening to us give a more in-depth pitch of our company to potential investors. Pitch deck I'll save for last. The elevator pitch is basically just a message, right? A verbal or oral message that you should have honed down as basically just rolling off the tip of your tongue. And this is that classic, hey, if you're stuck in an elevator going up 5 floors, and someone in the elevator next to you says, hey, so what do you do for a living? Then, you know, in 1 minute or 2 minutes, you should be able to explain not only what you do, but what your vision is and what your company is all about. And again, it's really the idea is to make it exciting, make it seem compelling, and make that person want to find out more, right? Clearly, you're not going to sell the company. You're not going to find an investor who will listen to a 1 minute pitch and say, yeah, I'm interested. The idea for both the executive summary and the elevator pitch is, again, to whet that appetite of the person who's listening to it or seeing it, to want to take the next step and want to take a meeting with you where you and your team could do a full-blown presentation of your pitch deck and your investment summary. The pitch deck is kind of the guts of the of your fundraising efforts in terms of planning for fundraising, and this is that kind of the slide set, right? That you're going to want to present to potential investors, and this is kind of where you get a little bit more in depth in terms of the message that you have, the opportunities, you know, both the market size as well as, you know, why we're the ones who are best equipped to take advantage of the opportunity, and why it's going to be a great investment for the people who are listening to the presentation. So Warren, if you could just kind of move forward to the next slide. And really, the main takeaways, we don't want to get too in-depth in this because like I said, this, requires probably an hour or two just on its own to talk about. But basically, it's, you're going to want to put together somewhere in the range of, 10 to 12 slides, not much more than that. You're going to have backups, but you're going to, these are kind of the main things that you're going to want to touch upon. I would encourage you, if you are, if this is of interest to you, I would encourage you to look online. There's tons of examples of successful pitch decks that have been presented that have raised a lot of money. And so look for those. But the main gist of it is that you kind of want to be able to encapsulate what the investment idea is, within a 10 to 12 slide deck. You're going to want to use a lot of pictures, charts, graphs. You don't want a lot of verbiage. You just want it to be, again, increase the appetite and increase the interest level of the investors so that, they will see it and they will want to take the next step. Again, every one of these items is the goal is to have the audience take the next step, which in this case would be, yes, this sounds exciting, this sounds interesting, I want to take the next step, let's go through some due diligence discussions so we can find out more about the opportunity.
That brings us into, with that, a little bit of nitty gritty about bottom-up financial projections into the pitch deck.
Yeah, so one of the elements in a pitch deck is the financial slide. That's typically either 1 to 3 slides that cover your financials. And the key part, especially if you're very early on, is the projections or forecasts that you put on that slide. There are 2 types of forecasting processes that we talk about: bottom up and top down. Bottom up is essentially a more detailed version of your forecast. It encompasses things like, for revenue, for example, if you have a pipeline, your forecast on a bottom up scenario will be based on that pipeline. That's either by customer or by sales hire, or whatever methodology that you could pin down that's a little bit more specific in your revenue forecast. That is a bottom-up approach to forecasting your revenue. On the spend side, either the cost of sales or the operating spend side, you want to get into a little bit more detail in a bottom-up scenario where, for example, the largest element might be your payroll. And in that case, it would be down to the type of hire. I'm going to hire 5 software engineers and at these dates, and I'm forecasting that they will get paid X. And that same goes for other major expenses, development expenses, consultants, software tools, fixed assets. It forces you to kind of look at your forecast on a very detailed level to create this bottom-up forecast. And when you do this, it's always better to involve your stakeholders to the extent that you have other participants in your companies, heads of engineering, heads of sales, and so on. Involve them in the bottom-up forecast so they are stakeholders and you get the best projection possible to present to your potential investors. The one item here that I actually recommend for anybody doing a forecast for the first time is to involve somebody that knows financials. For example, if you're a software as a service company, you might have revenue recognition revenue recognition issues that are not clearly apparent to a lot of folks, but an investor would want to see. Also, a financial professional could help you with key metrics in say, a software as a service SaaS environment, help you calculate these key metrics that potential investors will want to see. So having somebody at least take a sanity check at your bottom-up forecast would really help you and make your presentation look a lot more professional and also credible to a potential investor. So when creating this bottom-up forecast, having somebody involved is really key. Please keep in mind that a bottom-up forecast is typically, I counsel really 1 year out, maybe 2 years out at the very most. Beyond that, doing a bottom-up forecast is probably not very helpful. You should just focus on the near term. The next type of forecasting is a top-down, and that'll be in the next slide. Top-down is essentially how it sounds. You're doing a more or less granular approach than a bottom-up forecast. For revenue, for example, instead of looking at pipeline or looking at sales quotas or and so on, you might be looking at kind of a market size that you're trying to address, and what percentage of that market size will you be able to capture for your revenue. Again, very high level, not based on any kind of specifics or any kind of operational strategy. It's just kind of based on assumptions and facts, market size facts and so on for the revenue part segment. Your expenses in a top-down scenario might not be, for payroll, for example, might be a percentage of sales or just kind of an overall percentage for buckets of spending like sales and marketing, engineering, G&A, that is comparable to other companies in your segment. So a top-down typically is something that you would want to do for outlying years. So say, for example, you're doing a 5-year forecast. A top-down forecast might be used for years 3 to 5. And your bottom-up forecast might be used for years 1 to 2. So essentially, that's the 2 different types of projections that most folks do.
Oh, thank you, Alaa, for outlining all that. We have one question of how would you present both within the pitch deck, or how would you balance between the two when making an initial pitch?
As I mentioned before, yeah, I think that question is spot on. Typically, the bottom-up projection is either for year 1 or year 2 at the very most. That type of detail is in the bottom-up projection, and typically investors want at least a 3-year forecast. I counsel my clients to do a 1-year bottom-up and a 2-year top-down. To the extent that you have information for beyond that, maybe you do a 2-year bottom-up and a 1-year top-down in a 3-year scenario. And anything beyond 3 years, you would definitely do a top-down. The nice thing about doing a bottom-up forecast for year 1 is it will guide a top-down forecast for subsequent years. For example, if in year 1 you have a pretty detailed analysis of your revenue forecast, year 2, year 3, or year 4, you could simply do kind of a growth estimate based on some solid assumptions from your base year. And it starts giving you a more cohesive look into your forecast when you start with a good foundation with a bottom-up forecast for year 1.
Excellent. Thank you very much for your input on that. And let's go on to post-funding and talk a little bit about that and how that affects our companies.
Sure, and I'll take this. So, after you get a round of financing under your belt, and first of all, congratulations for doing that, because it's a huge activity. It'll take a lot of time, but once you actually have that funding under your belt, now you're kind of ready to really expand your business, hopefully on the product development side as well as the revenue generation side. But on the accounting side and the infrastructure administrative side, there are definitely some things that we're going to want to do. So we'll talk a little bit about kind of the accounting standards. You know, we talk a lot about GAAP, or generally accepted accounting principles. And the main difference here is that, you know, prior to fundraising, you know, the way that you kept records may have been, you know, it didn't necessarily have to conform to any standards or principles that people use. You might have just been worried about, hey, look, I just want to understand how much cash I have and how much I'm spending and how much I'm racking up in credit card bills, and how much I'm digging myself into a hole. But beyond that, there wasn't really much of a need. Once you receive financing from outsiders, the reporting requirements are going to change and increase dramatically. They're going to want to have a standard set of financials which they can use to view and to make sure that they are confident that the financial statements that they're seeing truly reflect the financial condition of the company. And so prior to this, you might have used some cash accounting where, you know, everything is cash based, right? When cash comes in the door, you record it as revenue. When cash goes out the door, you recognize that as an expense. But that, you know, allows people to kind of play around with numbers. So for example, you may decide to hold off on paying a vendor. And by holding off by paying a vendor, if you're using cash accounting, it kind of makes your financials look different in different periods depending on what you want to do. And that's one of the reasons why investors are going to want to use accrual-based accounting, which is kind of the second bullet point here. And this is where you recognize expenses and revenue when they are incurred or when they are earned. And so, for example, revenue may be a classic case where, hey, we ship a product to a customer or a distributor, and they don't actually pay us. So we ship it in September, but they don't pay us until November. Well, if we're using it based upon cash accounting, then we wouldn't recognize that revenue until November. But in an accrual base, then we're going to recognize that revenue when it is earned, which is when it is shipped in September. Same thing with expenses. So again, you know, you may hire a consultant. Or you may hire an R&D firm to do some work for us, and they start working in September, and they do a fair amount of work, and let's say we spend $10,000 or we incur $10,000 of expenses. But they don't invoice us until October, and then we have net 30 terms, so we don't pay them until, you know, the end of October or even early November. Again, we're going to recognize that expense in September when it is incurred rather than when it is paid. And by doing that, what that does is that basically gives an outsider who's looking at our books an understanding of kind of, you know, what commitments we've made, what kind of revenue we've earned, and they can do an apples-to-apples comparison of our financials against some other companies' financials. And so it allows investors a really good look at what's going on with our business without having to ask questions of, hey, well, what about the timing of these collections, or what about timing of these payments? Which obviously raises lots of questions and makes it easy for someone to kind of manipulate, you know, what the financials might look like.
Well, thank you very much, sir. And
and I apologize. Yeah, if you go a couple slides forward. Yeah. So and then there's now when it comes to financial statements, and these are the kind of the three financial statements that you're going to want to give to your investors. They basically make up the classic, you know, three sets of financial statements that, you know, lots of people know about, which is the income statement, the balance sheet, and the statement of cash flows. The first one is an income statement, and here there's a very, very obviously a simple example, and it's actually missing one major piece, which is the cost of goods sold. But basically, this is where, you know, for whatever period you're looking at, whether it's for the year, whether it's for a month, whether it's for a quarter, you're basically going to report, you know, how much revenue you earned. And then you're also going to record underneath revenue, which is missing here, which is the cost of goods that we sold, or the cost of services that we provided. And if you subtract that out, then we kind of get to a metric we call gross margin or gross profit, which is how much we actually made or earned from the revenues that we generated. And then underneath that are kind of all the other expenses that we incur to run the business, and whether you want to do it by function or by type of expense, which is the way that it's laid out here. So you can see, for example, salaries, rent, and other operating expenses are 3 line items. You might want to look at it instead of by type of activity. You might want to look at it by department. So for example, if you are growing the company and now you're starting to hire people in different functions, you might hire a VP of engineering, you might hire a VP of sales, and you might hire a CFO. And all of those different functions are going to be managing their own departments, right? G&A, R&D, and sales and marketing. And so you might want to split out your expenses by department / function as opposed to the type of activity. So, kind of depending on how you want to report it, that's kind of up to you, and it kind of depends on the business that you have and the stage that you're at. And you might change that over time, but this is kind of a classic look at a very simple income statement. Next slide, Oren, is the balance sheet, and this is basically a snapshot. Whereas an income statement takes a look at your activity over a period of time, the balance sheet is a snapshot of what our financials look like, our assets, liabilities, and our equity at a point in time. And so this is, as you can see, this would be a balance sheet as of December 31st, 2012 for Startup X, and it shows on one side of the ledger your assets. And then on the other side of your ledger, the liabilities and your stockholders' equity. And true to the name, the balance sheet, this should always balance. So the two sides have to balance, and to the extent that you have losses or gains in any period, all that will kind of show up in this retained earnings line that you see here, which kind of makes up the difference between what you owe in terms of liabilities and the equity in terms of stock that's outstanding. And then obviously your assets, and then the retained earnings will kind of fluctuate as you make money, and will help to balance out this balance sheet. The final statement that I'm sorry, Oren, was there a question?
Oh no, I was just going to say, and then we have one more form to show here. Should I cue that up?
Yeah. So the statement of cash flows is the third, and this is kind of where you, I guess, reconcile what happened on your income statement with other changes in cash. So again, since we're now reporting our accounting on an accrual basis, what happens on the income statement doesn't necessarily reflect what happened with cash, right? We collect cash or we spend cash on things that aren't necessarily reflected in a periodic income statement. And the statement of cash flows kind of combines the income statement and the balance sheet to show exactly what happened with cash. So for example, in this case, you can see that, okay, well, we had operating activities. So in addition to the net income that we generated, we also received cash from customers that wasn't part of that income statement in a given period. We might have spent money for buying inventory. We might have spent, we might have put some credit on with a vendor. And again, that's not going to show up in cash. So all those things kind of get reflected in the statement of cash flows, so that at the end of this thing, you'll see, okay, this is exactly where we ended, where we started with cash, where we ended with cash. And now that those three statements together, if you combine all those, if you look at all those three in conjunction with one another, you'll really get a sense as to what happened with the business from a financial perspective over that period of time. And that's kind of what the investors are going to be looking at, and that's what you should be looking at as you really review kind of how we're doing financially.
That's some really great in-depth stuff. And then I believe we have next the chart of accounts.
Yeah, the chart of accounts is it's basically all of the accounts that you're going to be setting up that will that make up those financial statements, right? So here you can see a whole bunch of assets, cash, accounts receivable, inventory, those kinds of things. There will also be accounts for revenue, as well as cost of goods sold and expenses. So basically, any line item that you see on either the balance sheet or the income statement is going to have an account. You're going to have to set up an account so that you can record transactions in each of those line items, so that they get reported when you present the financials.
Thanks very much, Sir.
The next one. So this is not necessarily an accounting thing, but it is for most of our clients. This is the nearest and dearest to their heart in terms of the number that or a chart that they should familiarize themselves with. So obviously, if you're making money and you're actually earning a profit, then this becomes less of an issue. But for many of our clients who are venture backed, they're spending money, right? They're developing product, they're trying to get customer traction, and in the early stages, we're going to be burning cash. And so this chart that tells us, gives us a snapshot of the history and the trend of our cash balance, as well as how much we're spending on a monthly basis. This is something that we have to know. We have to know how much we're burning, how much cash we have in the bank, and what our time to live is, or our runway, or when we run out of money. Those are three numbers that we always have to know. Our investors are going to want to know that on a monthly basis. Any changes to those numbers over time are going to have to be both communicated ASAP, as well as be able to defend, right? Why did that happen? Why did our cash burn increase from what we expected or what we had planned on before? And we're going to want to be able to report that and understand that.
We have a question on that. With what area is usually the most effective for targeting for impact if you see that your burn rate's running too high?
Well, in most cases, in most cases, and obviously it depends on the kind of company, and maybe Alaa can chime in here too. But in most cases, it's most of the burn for early stage companies is in payroll or outside services, right? So employees and consultants. Like a lot of companies hire R&D consultants, or they might hire marketing consultants to assist them in early stages. So that's usually where the biggest cuts are going to happen, where the biggest impact is going to be. But obviously, you give up a lot, right? There's a reason why you hired these people, or you hired these consulting firms to assist us, because the need is pretty great. So obviously you have to take a look at what we're getting for the money we're spending, and if we need to cut, then we have to look long and hard at where we could cut, at where it'll have the least amount of impact on our continuing operations. But some companies might be like really focused on generating traffic to their website, and they may be spending a ton of money with Google AdWords or Facebook advertising, and that might be a key component of the spending, and then you're going to want to look long and hard about how we can minimize those expenses as well. The next couple slides, so on the budgeting and financial planning, I think Alaa's already kind of touched upon many of this stuff at a high level. But especially for kind of near term, short term, that 1 year bottoms up forecast, you're gonna want to figure out kind of what are the key drivers, right? What are the key drivers of both of our spend as well as our revenue generation, and focus on those. I like to tell people that you can make a spreadsheet, do whatever you want it to do, and come up with whatever numbers that you want to come up with. The really key is in the assumptions, right? The underlying assumptions that are driving the model is really, and there's probably like 5 to 10 key variables, right? I mean, you could talk about, okay, well, there's going to be expenses for travel, and that might be an impact, but it's not going to have a huge impact for a lot of companies. There's going to be some key variables that, whether you toggle those on or off, or whether you increase that by 5 or 10 or 20%, that's going to have a much bigger impact on the numbers. And so we encourage you to focus on those. The running the different scenarios, we are big believers in setting up your templates to be able to run different forecasts. I'm a big fan of the kind of the expected case, the worst case, and best case scenarios to understand kind of the range of potential results and what we might be able to do. If we're not hitting our revenue targets, where can we cut? Where would we have to cut if we're not hitting the revenue targets? If our revenue starts going through the roof, what kind of triggers do we have to increase spending in areas to be able to support that revenue growth? So those kinds of things are important to be able to model out, and so putting together a model that gives us flexibility to be able to run different scenarios with a flip of a switch is I think important. And then, I'll also mention that we probably want to forecast on a 3-year plan at most. Internal controls is kind of the last slide in this area. This is one where, kind of pre-funding, this is probably not doable, but at some point, especially after fundraising, and now we've got a significant amount of cash that we're trying to manage, then putting some internal controls is really, really critical, right? So, the main thing here is having a segregation of duties. You don't want the same person who enters payments into our APN system to be the one who actually cuts the checks and sends it out, right? You want those to be separate people because then there's a check and balance in place so that someone can't, abscond with funds or set up a dummy account or dummy customer or I'm sorry, dummy vendor for whom we're sending payments that we shouldn't be sending out to. And to that point, you want to have different people doing different things, and you want to set up an approval process so that there is, we feel confident, and that investors feel confident that there's the right checks and balances in place, so that our cash and our assets are protected. Alaa mentioned before that there's something called Bill.com, which is a great software as a service platform for paying bills over time. It allows lots of flexibility in terms of who has approval access, who has access to enter bills and approve it, who ultimately has the approvals to finalize payment, and all those things should be set up with the goal that there is a check and balance, especially on the asset preservation side.
Just one addition to that on the internal control side, Sirk, is that right now there hasn't been, there's a lot of tools, again, available for you to control, especially if you're a small company. You're not going to be setting up, formal controls, but just a couple of little techniques that help. A lot of companies early on, they'll get a bank account and they'll print out a bunch of debit cards and they'll hand those out to various people in the company for expenditures that might happen. That's a big danger. Remember, debit cards draw directly from your bank account. Don't lose control over the debit cards. Have somebody, one person, preferably yourself in a small company, control that card and know what's being charged at all times. Don't let that number out, and control over that. The other one is in the payment side. If you use one of the payment services, as I mentioned before, Bill.com, it gives you the capability of having a separate person enter transactions into the system than the one approving it. And I recommend, especially to smaller companies early on, that this type of system be put in place. I know when we engage with a customer, we insist that we use something like a Bill.com so we could process all the different payments and bills and so on. But we also insist that the reason why we do that is we don't ever want to touch clients' bank accounts. And this allows us to enter transactions and then have somebody else in the company approve it. And with that separate vision, not only do you control of what's being spent, but you get also an eye of what what kind of expenses are going through the company. So it's a good Besides being a good control, it's also a good fiscal practice.
Excellent
Just
point.
a couple of recommendations.
Excellent points, Alaa.
Yeah. So
I think we have time for one last part, and we've covered a lot of areas. Can we talk about how we sum all this into evaluations?
Anyways, yeah, I think we've talked about various systems, and one of the things that that we meant, I think Sirk mentioned early on, is that if you have a stock option plan, the IRS put up a regulation a while ago, Regulation 409A. And right now, all companies that have a qualified stock option plan are required, at least on an annual basis, to get what's called a 409A valuation. So that is a requirement. It has to be done at least annually for the evergreen protections to kick in, or when there's a material event that happens to your company. A material event that would affect valuation would be things like a equity fundraise, something that happens in your industry to make you really either hot or really cold, that may have affected, say, for example, a company that your technology has now become used by a large corporation like a Google or an Apple, and all of a sudden that affects your valuation. So that would require an additional valuation prior to the annual cycle, or if you get acquired, or if you acquire another company. Those are the kind of events that may occur that would require you to do these valuations sooner than the annual requirement. But when you pick right now, 409A valuations have become a commodity. The cost for these valuations are all over the place. They could be huge if you utilize, say, a Big Four type accounting firm, or it could be rather small if you use some of these companies like eShares, and they do it for a very, very low cost. And there's also international providers that do it from other countries at a very, very low cost. So things to be aware of is that these valuations are pretty important. And if your company grows to a point where there is an event that happens, either a public offering, or you get acquired by a bigger company, or you get an audit by a Big Four company, they're going to be looking at these valuations. And that look may be 2 or 3 years down the line. So when you're picking a company, make sure that this whoever is doing your valuation is not just credible and professional, but will work with you to obtain whatever the best possible price. A lot of times when you use these online valuation companies or these international, they just kind of run it through a program or an algorithm and come up with a result, and that's what you're stuck with, and there's nobody to talk about. So having a company that could engage in some interaction during the valuation process is key. Make sure you get a company that doesn't just give you the result that you want, that give you a result that will withstand an audit, either by the IRS or by a large, like a Big Four accounting firm in an audit environment. The reason for that is that down the road, if it doesn't withstand that, you could have a pretty big compensation hit on your income statement, and you don't want any surprises later on. And then the other thing, when you're picking a 409A valuation company, since they're doing this work, you never know what other kind of valuation work that you may need down the line. So it's good to have a good relationship with this company going forward, so they're familiar with your business, they're familiar with your space. Remember, you'll need to do this on an annual basis, so you don't want to recreate the wheel every single year. And then to the extent that they get it wrong, and there's material assumption errors, or you identify some things that they didn't, make sure that the 409 valuation firm will do free revisions. They're not going to kind of nickel and dime you saying, oh yeah, we charge you $1,000, but now that you have this, it's another $3,000. So just make sure you get that in writing prior to signing with a firm. And then finally, ask about how quickly they get it to you. Typically, when you're doing a 409 valuation, the one thing that might be in queue is pricing for stock options. You don't want your employees to wait months and months and months to know what their per share price is going to be for the options that you just granted them. So those are kind of few points that you should consider when picking a 409A valuation company.
Thank you very much, Alaa. And with that, we'll be concluding, unless there's any more questions. It's like I don't have any. So let me put on the contact sheet. So that has been Sirk and Alaa, our two CFOs from Early Growth Financial Services. And hold on, and if you have any questions, you can email us or call us and see our videos on our YouTube channel. Thank you very much, guys, for all of your information.
Thank you very much, and we appreciate you guys all taking time out of your busy schedules to spend an hour with us, and we wish you the best of luck.